Just 1 minute ago, Ford sent shockwaves through the global auto industry when its CEO confirmed in yesterday's closed-door conference that production of Ford's electric pickup trucks is being shut down, at least for now, and the reason is far bigger than most people realize. This was not a rumor, not a leak, and not speculation. This was a calculated decision made at the highest level, driven by collapsing demand, rising production costs, and a brutal reality Ford can no longer ignore. The electric pickup experiment is bleeding money, dealer lots are filling up, and buyers are walking away despite incentives that would have been unthinkable just a year ago. According to executives inside the room, Ford's CEO admitted that electric pickup trucks are simply not selling at the volume needed to justify continued production. High sticker prices, weak charging infrastructure, towing range anxiety, and expensive battery replacements have created a perfect storm. Traditional truck buyers are hesitant, fleet buyers are backing out, and rural customers, the backbone of Ford's truck business, are rejecting electric trucks outright. Ford expected a fast EV transition, but the market delivered a hard stop instead. At the same time, Ford is slashing prices aggressively, and this move is not optional, it is survival. Inventory levels are rising across dealerships, financing rates remain painful, and consumers are delaying big purchases. Ford knows that if vehicles sit too long, they become financial liabilities. Price cuts are now the only lever left to pull to move metal, free up cash flow, and prevent deeper losses before the next earnings call exposes the damage. The models hit hardest by these price slashes include electric SUVs, electric crossovers, and several gas-powered models that Ford overproduced while demand softened. Insiders confirm that discounts are appearing on the Mustang Mach-E, electric commercial vans, and even select F-150 trims. Some regions are already seeing thousands shaved off MSRP, with dealer incentives stacking on top of factory rebates, creating the most aggressive pricing Ford has offered in years. For buyers, this changes everything. Customers who were priced out just months ago suddenly have leverage. Negotiation power has shifted from dealers back to consumers. Buyers willing to wait, compare offers, and shop across regions are locking in deals that were impossible during the post-pandemic boom. However, early EV adopters are furious as resale values slide, and many feel trapped in vehicles now worth far less than what they paid. The reaction across the industry has been immediate and tense. Competitors are watching closely because Ford's move signals a deeper problem with electric truck demand, not just at Ford, but across the entire market. Rival automakers are quietly reevaluating their EV timelines, delaying launches, and scaling back production targets without making public announcements. No one wants to admit it first, but Ford just forced that conversation into the open. Inside Ford's workforce, the mood is uneasy. Production slowdowns raise questions about job security, overtime cuts, and future plant investments. Workers are worried, unions are demanding clarity, and management is under pressure to explain how this strategy protects jobs in the long term. The shutdown may be temporary, but the message is permanent. The EV transition is no longer guaranteed, and the rules of the car market are being rewritten in real time. And as this announcement continues to ripple through Wall Street, dealerships, and factory floors, one critical question remains unanswered: whether Ford's drastic pivot will stabilize the company or trigger an even larger domino effect that forces the entire auto industry to rethink what comes next. Because what's happening right now is only the beginning of a much bigger shift that no one saw coming when Ford first bet everything on electric trucks. Behind the scenes, analysts are already warning that Ford's decision is not an isolated event, but a signal that the EV hype cycle has officially collided with economic reality. Executives inside Ford reportedly acknowledge that battery costs remain far higher than projected, while federal incentives failed to move the needle the way policymakers promised. The math simply stopped working. Every electric pickup rolling off the line was generating thinner margins than gas-powered trucks, and in some cases, outright losses that could no longer be justified to shareholders. This is exactly why Ford's price cuts are landing with such force. The company is racing to protect market share before competitors do the same, because once one major automaker blinks, the entire pricing structure of the industry starts to unravel. Dealers are being told to prepare for sustained discounting, not short-term promotions, and that message alone is enough to panic rival brands that are already sitting on excess inventory of their own. For consumers, this moment represents a rare window where timing matters more than brand loyalty. Buyers who understand what is unfolding can take advantage of desperate manufacturers manufacturers trying to stabilize sales numbers before quarterly reports go public. Ford knows that once buyers realize prices may continue falling, hesitation increases, so these cuts are designed to create urgency even as confidence in EV pricing erodes. Competitors are responding quietly but aggressively. Some are freezing EV investments, others are shifting marketing budgets back toward hybrids and efficient gas models, and a few are delaying factory expansions that were once promoted as inevitable. Publicly, they remain optimistic. Privately, they are scrambling because Ford's announcement has exposed vulnerabilities they were hoping to hide for another year or two. Inside Ford's factories, workers are now waiting for concrete answers. Production slowdowns always start with temporary pauses, but employees know how quickly pauses can turn into permanent reductions. Union leadership is pressing management for guarantees, while supervisors are being instructed to control overtime and prepare contingency staffing plans if demand fails to rebound. And while Ford insists this move is about strategic realignment, not retreat, investors are reading between the lines. Stock market reactions suggest confidence is fragile, and analysts are already revising forecasts to account for slower EV adoption and prolonged price wars. The fear is not just lower profits, it's a drawn-out battle that compresses margins across the entire industry. What makes this moment even more critical is that Ford built its future roadmap around electric trucks leading the transition. With that pillar now cracking, every downstream plan, from supplier contracts to battery partnerships, is being re-evaluated under pressure, setting the stage for decisions that could reshape the company far beyond this single announcement as the consequences of today's shock continue to unfold. What's becoming increasingly clear is that Ford is no longer chasing headlines. It is trying to stop the bleeding before it spreads any further. Executives now admit that consumer behavior has shifted faster than forecasts predicted. Buyers are prioritizing affordability, reliability, and long-term ownership costs, and electric pickups are failing on all three fronts. Insurance premiums are higher, repair costs are unpredictable, and charging concerns remain unresolved for millions of potential customers, especially outside major cities. This is where Ford's strategy takes a sharp turn. Instead of pushing electric trucks at all costs, the company is redirecting focus toward hybrids and lower-priced gas models that can be built profitably right now. Internally, this is being framed as market alignment, but industry insiders see it as a necessary retreat to protect Ford's core business before irreversible damage occurs. The message is subtle but powerful. Ford is following demand, not ideology. Dealerships are already feeling the impact. Sales managers report increased foot traffic from buyers who were previously priced out, while at the same time dealing with frustrated EV owners watching their vehicle values slide. Trade-ins are becoming harder to appraise, and dealers are being forced to absorb losses or pass them along to customers, further complicating negotiations on the showroom floor. Meanwhile, suppliers are bracing for shockwaves. Battery manufacturers, component suppliers, and logistics partners that scaled up aggressively for electric truck production are now facing reduced orders and uncertain contracts. When production slows, the pain doesn't stop at the assembly line. It ripples through the entire supply chain, threatening smaller companies that depend heavily on Ford's volume commitments. Competitors are taking notes in real time. Some are quietly preparing price cuts of their own, while others are reconsidering whether electric pickups should remain centerpieces of their future lineups. The industry is realizing that forcing EVs into a market that isn't ready creates more risk than reward, and Ford's announcement has accelerated that realization overnight. For workers and communities tied to Ford plants, the uncertainty is growing. Even short-term production pauses can impact local economies, overtime pay, and job security. While leadership emphasizes long-term stability, employees understand that stability only exists if demand returns. And right now, demand is sending a very different message. As this situation continues to evolve, one thing is undeniable. Ford has triggered a chain reaction that goes far beyond price cuts and paused production, and the next moves the company makes will determine whether this shock becomes a controlled correction or the opening chapter of a much deeper industry-wide reckoning that is still unfolding in real time. What makes this moment especially dangerous for the industry is timing. Ford is making these moves while the broader economy is under pressure. Consumer confidence is fragile, and auto loan delinquencies are creeping higher. This combination leaves very little margin for error. If buyers sense that prices will keep falling, they delay purchases even longer, and that hesitation can quickly spiral into a demand freeze freeze that no amount of marketing can fix. Ford's leadership understands this risk, which is why the company is moving fast and quietly rewriting internal targets. Sales volume expectations are being lowered, production schedules are being adjusted month by month, and future EV investments are now being forced to justify profitability instead of growth alone. That shift in mindset is massive because for years the strategy was scale first, profit later, and that playbook is no longer viable. Another critical factor driving this decision is the growing gap between early EV adopters and mainstream buyers. Early adopters accepted trade-offs in exchange for being first. Mainstream buyers do not. They expect electric trucks to match gas models in price, convenience, and capability, and when they don't, they walk away. Ford's data shows that interest drops sharply once buyers understand real-world range under load, cold weather performance, and charging downtime. The competitive response is becoming more visible by the hour. Incentives are quietly expanding across rival brands. Lease deals are becoming more aggressive, and unsold EV inventory is being shifted between regions to mask demand weaknesses. No automaker wants to be the next headline, but Ford's announcement has made silence impossible. Inside Ford, communication has become tightly controlled. Managers are being briefed with talking points focused on flexibility and long-term strength, while internal teams work around the clock to reassess supply contracts and manufacturing footprints. Every delayed vehicle, every discounted unit feeds into decisions that could reshape Ford's product lineup for the next decade. For buyers watching from the sidelines, this moment is about leverage. The balance of power has shifted, and manufacturers know it. Discounts, incentives, and negotiations that were once dismissed are now standard practice, but the window may not stay open forever, because if production cuts deepen, availability could tighten again just as quickly. And as Ford's shock announcement continues to echo across boardrooms, dealerships, and factory floors, the industry is inching closer to a breaking point, where hard decisions replace ambitious promises, and the future of electric trucks hangs in the balance, with the next move poised to change everything once again. Now the pressure is intensifying from another direction. Regulators and investors who were promised rapid electrification and strong returns are demanding explanations. Ford is walking a tightrope, trying to reassure markets that it remains committed to electrification, while simultaneously pulling back from the very products that symbolize that commitment. This contradiction is not lost on analysts, and it is fueling deeper questions about whether the industry moved too fast without securing real consumer buy-in. At the dealer level, the reality is even more blunt. Showrooms are packed with vehicles that were ordered months ago under very different market conditions. Floor plan costs are rising, margins are shrinking, and dealers are being forced to choose between moving inventory at a loss or letting vehicles sit and depreciate further. Ford's price slashes help move units, but they also confirm dealers' worst fear, that pricing power has vanished. Another overlooked impact is on fleet and commercial buyers. These customers were expected to anchor electric pickup demand, but many are now hitting pause. Charging logistics, downtime, and total cost of ownership calculations are not lining up as promised. When fleets hesitate, volume collapses quickly, and Ford's leadership knows that without fleet adoption, electric pickups cannot scale. Competitors are now adjusting their messaging in real time. The tone has shifted away from bold EV dominance claims toward choice, flexibility, and customer-led transitions. This subtle change signals a major retreat from the all-electric narrative, and Ford's announcement is widely seen as the catalyst that made this repositioning unavoidable. Within Ford's workforce, uncertainty is turning into frustration. Workers want clarity, not slogans. Temporary pauses create anxiety, and anxiety impacts morale and productivity. Union leaders are demanding transparency on how long shutdowns could last and whether future investments will favor existing plants or shift elsewhere. What happens next will depend on how quickly demand stabilizes or whether it continues to weaken. If price cuts fail to reignite sales, deeper production reductions may follow. If competitors respond with even more aggressive discounts, the industry could slide into a prolonged price war that reshapes profit structures for years. And as this standoff unfolds, Ford's announcement stands as a defining moment, a clear warning that the auto market has entered a new phase where assumptions are being challenged, strategies are being rewritten, and the next development could arrive at any moment, pushing this already volatile situation into an entirely new chapter that is still taking shape. What is quietly alarming executives across the industry is how fast sentiment has turned. Just months ago, electric trucks were positioned as the future profit engine. Today, they are being discussed as a risk exposure. That reversal is forcing emergency scenario planning inside Ford and beyond, because once confidence cracks, rebuilding it becomes exponentially harder. Ford's internal data reportedly shows that incentives are no longer creating excitement, they are creating skepticism. Buyers are asking why prices are falling so quickly and whether better deals are coming. This hesitation is toxic for sales momentum, and it explains why Ford chose to act decisively now rather than allow uncertainty to drag on for another quarter. There is also a global dimension to this decision. International markets have not embraced electric pickups the way Ford expected, leaving excess capacity with limited export potential. Plants designed to scale globally are now being throttled back, adding pressure to already complex logistics and cost structures. What looked like a global opportunity is suddenly a domestic challenge. Suppliers are renegotiating terms, logistics partners are revising forecasts, and financing arms are adjusting residual value assumptions almost weekly. Every adjustment ripples outward, tightening conditions across the ecosystem that supports vehicle production and sales. This is how a single production decision can cascade into a much broader industry slowdown. Competitors are now facing an uncomfortable choice: follow Ford and risk confirming weak demand, or hold course and risk being stuck with unsold inventory. Neither option is attractive. That's why many are choosing quiet adjustments instead of public announcements, hoping to avoid becoming the next headline. For consumers, the psychological shift is just as significant as the financial one. The perception that waiting pays off is spreading, and once that mindset takes hold, even aggressive deals struggle to break it. Ford's challenge is not just moving inventory, it is restoring urgency in a market that has learned patience. And as all of this unfolds, the implications extend far beyond electric trucks. The credibility of long-term forecasts, government targets, and industry promises is being tested in real time. Ford's announcement has cracked the surface, revealing deeper structural issues that were building quietly beneath years of optimism, setting the stage for consequences that are still emerging and could reshape the auto industry in ways no one fully anticipated yet. At this stage, the most critical factor is what Ford does next behind closed doors. Sources indicate that leadership is reevaluating future capital allocation, with projects once fast-tracked now being delayed or rescoped entirely. Battery investments, dedicated EV platforms, and expansion plans are all being forced through a harsher filter, one that demands near-term returns instead of distant promises. This represents a fundamental shift in how Ford is thinking about risk. Marketing strategy is also changing rapidly. The language around electric dominance is being replaced with narratives centered on value, durability, and choice. Hybrids are suddenly front and center again, positioned as the practical bridge rather than a temporary stopgap. This recalibration is designed to stabilize demand without alienating buyers who are not ready to go fully electric. Dealers are being instructed to focus on clearing inventory rather than protecting margins. That directive alone signals how serious the situation is. When volume becomes more important than profit per unit, it reflects a company trying to regain control of the sales pipeline before conditions deteriorate further. Meanwhile, competitors are closely monitoring Ford's data, even as they publicly downplay the impact. Internal meetings across the industry are now dominated by the same questions: how real is EV demand? How long will price pressure last? And how quickly can production be adjusted if the slowdown deepens? Ford has effectively become the case study everyone else is studying. For workers, the waiting continues. Production pauses create a sense of instability that no amount of reassurance can fully offset. Communities built around manufacturing plants are watching closely, knowing that even temporary slowdowns can have lasting economic effects. The broader financial markets are also paying attention. Analysts are revising long-term projections, and lenders are tightening assumptions around residual values and leasing structures. These changes may not make headlines immediately, but they quietly influence affordability and availability for buyers nationwide. And as this recalibration accelerates, one reality is becoming unavoidable. The era of unchecked optimism in the auto industry is giving way to a phase defined by caution, correction, and hard trade-offs, with Ford's shocking announcement marking a turning point that continues to unfold, revealing new implications with each passing day as the story is still far from over. This is no longer just a Ford story, it's a warning signal for the entire car market. When an industry leader pulls the brakes this hard, it tells us something fundamental has changed. changed. Buyers, workers, investors, and competitors are all being forced to reassess what they thought was inevitable because the ground is shifting in real time. What happens next will define not just Ford's future, but the direction of the auto industry itself. Will demand rebound, or will this trigger deeper cutbacks and an all-out price war? One thing is certain, the decisions being made right now will reshape what you see on dealership lots for years to come. Stay locked in, because this story is still developing and the next update could change everything.